Welcome back to Investing Talk Podcast.
Today we're looking at Namib Minerals.
As usual, before we start, subscribe, like, and comment to this video to support the show. Now, I have to be honest with you. When I pulled up my terminal on January 21st, I actually, tapped the screen a few times. Thought the data feed was broken. You just don't see those kinds of numbers on a random Tuesday.
No, you definitely don't. You're talking about that 131% surge in a single day, right?
Exactly. And it didn't even stop there. If you zoom out just a little, for the last week, the stock's up over 200%. That kind of move usually means one of two things. Either they just hit the mother lode or something is just mechanically broken. But here's the thing that makes me nervous. You know I'm the skeptic here. I immediately flipped over to the balance sheet.
When you saw the red ink.
Red ink is putting it lightly.
Yeah.
I saw a massive disconnect. We're looking at a company with negative stockholder equity.
Right.
I mean, on paper, they are completely underwater.
Right.
Yet the market is buying this thing like it's a tech IPO in the 90s. It just feels irrational.
Well, it certainly looks like a paradox. You've got a distressed balance sheet colliding with, truly explosive price action. But that's exactly why we're digging into this today.
All right.
Our mission is to figure out what's really driving this. Is it a genuine fundamental turnaround, based on gold prices and real operational fixes? Or is this just a classic low float liquidity trap where people are going to get caught holding the bag?
That is the million-dollar question. Is this a diamond in the rough or just fool's gold? So let's start peeling back the layers. We have to start with the fundamentals because the top-line numbers are sending some mixed signals. They reported revenue of $85.88 million recently. Sounds okay. But then you look at the estimates for the first half of 2025, and they're coming in at $36.38 million.
Which is a pretty big drop.
It's a 13.2% year-over-year decline. Usually when a stock triples in a week, you want the revenue chart pointing up, not sliding down.
That's a fair point, but I think context is everything here. If you only look at revenue, you're missing the real story. This isn't a growth at all costs play right now.
It's a survival play.
Exactly. It's a survival and profitability narrative. So while revenue is dipping, look at what they're keeping. Their profit margins are sitting at 47.57%.
Almost 50% for a miner.
Yes. That's incredibly healthy. And this is where the bullish argument really starts. It's all about cost discipline. You have to look at the on-mine, all-in sustaining costs, or AISC.
Okay, so for anyone listening who doesn't read mining reports for fun, let's break that down. AISC is basically the break-even price, right? What it costs to get 1 ounce of gold out of the ground.
Precisely. It's the most important metric for profitability. And for Namib Minerals, that number dropped 8%. Month on month. It's down to $2,140 an ounce. Wow. In the mining world, cutting your sustaining costs by 8% in a month is huge. It means they're operating way more efficiently than they were just a quarter ago.
Okay, so they're getting leaner. I can give them credit for that. If you're selling less gold but keeping more profit on each ounce, that's a valid strategy, especially with high gold prices. But you can't cut your way to growth forever. Eventually, you have to actually produce more.
And that takes us to the forward guidance. They aren't just cutting, they're projecting 2025 production to hit between 24 and 25,000 ounces. But the real kicker, the number that has investors interested, is that adjusted EBITDA target.
Which is their operating cash flow proxy.
Right. They are aiming for $22 to $26 million in adjusted EBITDA. If they hit that, we're talking about a serious earnings reversal. They're signaling to the market, we've stopped the bleeding and we're about to start printing cash again.
They stabilize the ship feels generous when we look at the balance sheet. This is the part of the analysis where I have to point out the ugly.
Do you want?
We can't ignore the stockholder equity. It's negative $30.93 million.
It's a big number.
It's a terrifying number. For anyone listening, negative equity means if the company sold everything today to pay its debts, shareholders would still owe $30 million. They'd get zero.
It's a precarious position, no question. Highly leveraged.
Precarious is an understatement. It's a danger zone. And on top of that, the current ratio is 0.14. A healthy company wants that over 1.0. A 0.14 means for every dollar in bills they have due soon, they only have 14 cents in cash to pay them. Plus, they just lost another $3.5 million this quarter. So how do you square financials like that with a 200% rally?
You square it by looking at what isn't on the balance sheet yet. The market is forward-looking. People aren't buying the debt they have today. They're buying the moat, the assets they're going to monetize tomorrow.
So the mines themselves.
The mines. The strategy is all focused on Zimbabwe, specifically the How mine and the restart of the Redwing mine.
Okay, and Zimbabwe adds a whole other political risk layer we need to get to, but tell me about this Redwing restart. Why is that the big deal?
That's the catalyst. The growth plan is incredibly aggressive. They're targeting an eventual annual production of 300,000 ounces.
300,000 from 24,000.
Yes. Remember, they're sitting on a resource base of 2.5 million ounces in the ground.
So the gold is there. It's a geology story versus a finance story.
Exactly. The argument is the market is repricing the stock based on that potential. And 300,000 ounces a year is a massive jump.
That's a 10x increase. That's ambitious.
It is. But they are making the moves. They have hedges in place to protect against gold price volatility. They're exploring in the DRC. Plus, they have big capex plans to expand milling capacity at the Howe mine from about 40,000 tons a month to 55,000 by the second half of 2026.
So they're spending money they barely have to build for the future.
They're betting on themselves. And if they pull it off, that leverage works in their favor.
Okay, so you've got this real tension, right? The company is financially distressed on paper, but they're aggressively expanding in the field.
It's a complete paradox.
It is, and that kind of explains the fundamental tension. But let's pivot and look at the charts, because honestly, that fundamental story, it doesn't fully explain the violence of this price move.
Violence is the right word for it. It has been explosive.
Walk us through this price action. We mentioned the 131% surge, but it hasn't exactly been a smooth ride-up.
No, not at all. On January 21st, we saw that huge vertical move, but it was almost immediately followed by a 12% drop. The volatility is extreme. Right now, it's trading around $3.10.
Which, to be fair, is still a bargain compared to its history.
Right. Context is key. The all-time high was $55 back in June of 2025. So even with this 200% weekly gain, the stock is still down over 70% from its peak.
And this is what I found fascinating. Why does the stock move 131% in a day? It's usually supply and demand physics. I checked the share structure. The public float is tiny.
How tiny?
Only 4.22 million shares available for trading.
Wow. That is incredibly low.
It's a liquidity bottleneck. Think of it like a crowded theater with a tiny door. With a float that small, any buying pressure is like a match in a powder keg. There aren't enough shares to go around, so the price gaps up instantly.
And that explains the beta.
Exactly.
Yeah.
The beta is 3.45. For those listening, that means the stock is more than 3 times as volatile as the overall market. If the S&P 500 sneezes, this stock catches the flu.
Or in this case, if the market cheers, this stock throws a parade.
A huge one. And it seems like the rising gold price just drove traders to look for a high-leverage play. They piled into this low-float name and sent it to the moon.
It's a classic supply shock. But we have to ask, how does the broader market actually feel about this? Is this just day traders having fun, or is there a real shift in sentiment?
Well, let's pivot to the sentiment analysis, because the data here is conflicting. And I love when data conflict.
Conflicting how?
I looked at the quantitative score. Alpha Vantage analyzed the last 5 major headlines. You'd think with the price up 200%, sentiment would be euphoric.
You would.
But the weighted score came back somewhat bearish, negative 0.15.
That's fascinating. The price is skyrocketing, but the news sentiment is negative.
Yes. Out of 5 stories, only 1 was bullish, the Redwing restart you mentioned. 1 was neutral. 3 were bearish. The algorithms are reading risk, even while the traders are buying the stock.
That suggests a dislocation between the headlines and what the market is expecting going forward. The price usually leads the news.
Right.
But if you look at analyst views, it's a completely different story. There's a price target out there of $9.50.
$9.50 from $3.10.
Right. That implies over 200% upside from here. The argument is pure valuation. Even after this rally, the stock is trading at a price-to-sales ratio of 2.1x.
And how does that compare to its peers?
The peer average is around 3.3x, so you could argue it's still undervalued relative to competitors. You're paying less for every dollar of their revenue.
What about that Zacks rating? I saw a strong sell from them on January 3rd.
I saw that too, but I'd argue it's just outdated. That was weeks ago, before the cost-cutting data came out. In a fast-moving story like this, a 3-week-old rating is ancient history. You have to look at the institutional flows to see what the smart money is doing now.
So who owns this thing?
Surprisingly, institutional ownership is high 59.54%. We see names like Polar Asset Management. These aren't just retail traders. Big money holds a majority of the stock.
That does provide a bit of a floor, but I haven't seen much insider buying, no Form 4s.
No, not recently. But with a float this low, just having institutions accumulate shares can create that support.
Okay, so it's a mixed bag. Cheap valuation, high institutional ownership, but bearish news. Now, I have to put my skeptic hat back on. We need to talk about what could go wrong. Let's pivot to the risks, because the elevator can go down just as fast.
The bear case. Let's do it.
Risk number one is insolvency. I just cannot get past that negative $30 million in equity. This company is walking a tightrope. If gold prices dip even a little bit, they have no cushion.
That's a fair point. They're leveraged to the hilt. If there are any operational delays or gold corrects, they don't have the cash to absorb the shock.
Risk number two is the speculation itself. The volatility cuts both ways. We saw that 12% drop right after the 131% rise. That shows how quickly these gains can just evaporate.
Right.
And the moves aren't always explained by news. Sometimes it's just market mechanics.
And risk number three.
Macro and political. We have to talk about Zimbabwe. It's not the most stable jurisdiction for mining. I read about those royalty hikes recently.
That's true, but there's a key nuance there. The government did reverse that a bit. The doubling of royalties only kicks in if gold prices go above $5,000 an ounce.
Which is a pretty high bar. We're a long way from $5,000 gold.
We are. So the immediate tax threat is gone, but the geopolitical risk is still there. But, high risk often comes with high reward. If this company were in Nevada, it wouldn't be trading at 2x sales.
True. You're getting the Africa discount.
Exactly. And for an investor with a high risk tolerance, that discount is the opportunity.
So we've covered the ugly financials, the explosive chart, the mixed sentiment, and the very real risks. Let's bring it all together. What's the verdict here?
Let's look at the catalyst calendar first. The next big date is March 27, 2026. That's earnings day.
The moment of truth.
It is. That's when we see if the cost cuts stuck. Before that, in February, we have the Redwing mine restart. That's a huge operational milestone.
So a lot of news flow in the next couple of months.
Tons. So here's my verdict. I'm giving this a bullish score of 7 out of 10.
A 7. That's pretty confident for a company with negative equity.
It is, but here's the thesis. This is a speculative swing trade, not a retirement stock. The company is undervalued at 2.1x sales. They have a clear path to 26 million in EBITDA if Redwing succeeds. And the cost cutting is real.
So the strategy is to ride the momentum into earnings.
Ideally, yes. You watch the Redwing news in February. If that goes well, you hold maybe through the second half of 2026 if the milling expansion stays on track. But you have to be agile.
Agile is the key word. You don't marry a stock like this. All right, for listeners watching the chart, what's the level to watch?
Watch the $3 level. It has to hold that support to keep the bullish structure alive. If it breaks below, that liquidity trapdoor could open fast.
$3, the line in the sand. This has been a fascinating look at a wild stock.
It's a high-stakes game of execution now.
Well, that wraps up our analysis on the Namib Minerals, a wild ride. Don't forget to subscribe, like, and comment to this video to support the show. We'll catch you on the next one.